The market is bleeding. Headlines are screaming crash. Your timeline is a sea of red candles and emotional damage. But while retail is panic selling, while the paper hands are smashing sell market like it's a fire alarm, the whales are feasting at $68,000. Million-dollar orders, silent accumulation, no tweets, no drama. So what is this moment really? A trap before the next leg down, or the last boarding call before Bitcoin takes off toward $100,000? Because history tells us something uncomfortable. Bitcoin doesn't reward the smartest people. It rewards the most patient. And right now, patience is in very short supply. Bitcoin is down 13% this month, and suddenly everyone on social media has a PhD in doom. But let's zoom out and look at what the people managing billions are actually doing. First, Michael Saylor. His famous line, "We are not selling." If conviction had a face, it would be his. His stance hasn't changed through crashes, bear markets, or media ridicule. To him, Bitcoin is a long-term treasury asset. He doesn't trade it. He doesn't time it. He accumulates it. Selling Bitcoin now, in his view, is like selling Manhattan in 1803 because the price dipped for a few weeks. His philosophy is simple. Volatility is temporary. Scarcity is permanent. Next, Geoff Kendrick at Standard Chartered. He's maintaining his $100,000 price target. This isn't hype or hopium. It's a macro-driven thesis based on institutional flows and supply shock dynamics. His view is that the 2025 rally priced in adoption, and now, in 2026, the market is just digesting it. Markets don't move in straight lines. They move in waves, and we're just in a pullback within a larger uptrend. And then there's Cathie Wood. She calls this phase exactly what it is: noise. Disruptive technologies don't climb smoothly. They shake out speculators. They test conviction. They eliminate the weak hands. The internet did it. Tesla did it. And now, Bitcoin is doing it. The question isn't whether volatility exists. The question is whether you understand what you hold. So why is this happening? Let's get real. Bitcoin didn't drop 13% because the universe hates your portfolio. There are clear, logical forces at work. First, profit-taking. 2025 was explosive. New highs, ETF inflows, institutional adoption headlines everywhere. If you bought in 2023 or early 2024, you're sitting on massive gains. When momentum slows, funds rebalance, and traders take profit. That's not fear, that's math. Markets need to breathe. Up, pause, up, correction, repeat. Second, the macro environment. Crypto doesn't exist in a vacuum. High interest rates, a strong dollar, and tightening global liquidity all play a role. When money becomes expensive, risk assets feel the pressure first. Not because they're broken, but because they're liquid. Bitcoin is often the easiest asset to sell when funds need cash. Ironically, that same liquidity is what makes it so attractive long-term. And finally, the biggest force in crypto, human emotion. At $90,000, the sentiment was, buy now or stay poor forever. At $68,000, it's sell before it goes to zero. Same asset, same fundamentals. Different price, different emotions. The market is just a mirror, reflecting fear when prices fall and greed when prices rise. Let's address the elephant in the room. If you panic at a 5% drop, Bitcoin might not be your asset. This thing has survived 80% drawdowns, government bans, exchange collapses, and media obituaries every single year since 2011. And yet, here we are. Every cycle, it's the same story. Retail buys in euphoria. The price dips. Panic selling begins. The whales accumulate. New all-time highs are reached. And then retail returns, but it's too late. If this cycle feels familiar, congratulations. You're starting to see the pattern. Stop right there. If you're a true hodler, smash that like button. If you're scared, type panic in the comments, and I'll tell you why you're wrong. Let's see who's holding and who's folding. But here's what almost nobody is talking about. There's an on-chain secret involving ETF flows tied to BlackRock that could flip the script in the next 24 hours. While retail sells in fear, institutional demand is quietly absorbing all the supply. And if this trend continues, the supply shock could hit much faster than anyone expects. The ETF reveal, what's really happening at 68K? Alright, let's pull back the curtain. While retail traders are panic selling at $68,000, institutional giants are doing the exact opposite. We're talking about continuous accumulation through spot ETFs, particularly those linked to BlackRock, quietly absorbing supply day after day. Here's the key dynamic most people miss. When you sell your Bitcoin through an exchange, that liquidity doesn't vanish, it gets bought. And increasingly, it's being bought by ETFs with long-term mandates. These aren't traders chasing a 10% swing. These are entities with 10-20-year horizons. So while retail screams crash, the supply is being locked away in cold storage. And here's where PlanB's updated stock-to-flow perspective for 2026 adds fuel to the fire. After the 2024 halving, Bitcoin's annual issuance dropped dramatically. Fewer new coins, same or growing demand. If ETFs continue absorbing more BTC than miners produce, we enter a structural supply deficit. Let that sink in. Not hype, not sentiment, math. And math doesn't care about your fear. Let's talk about the costliest habit in crypto, selling the dip. It feels logical in the moment. Price drops, fear increases. Sell to protect capital. But zoom out, and what's actually happening? You're transferring your Bitcoin from weak hands to strong hands, from short-term thinkers to long-term accumulators, from emotional decisions to strategic positioning. Every cycle, the same pattern repeats. Retail sells during fear. Institutions accumulate quietly. Supply tightens, price rises, retail buys back higher. It's not a theory, it's a redistribution mechanism. The market is not stealing your Bitcoin, you are handing it over voluntarily. And the whales? They send you a thank you card, probably embossed. The sell the dip trap works because it hijacks your survival instincts. Humans evolved to avoid danger. Red equals danger. Falling prices feel like danger. But markets aren't predators. They're auctions. And sometimes, the best opportunities look the scariest. Think about it. No one wanted Bitcoin at 3K. No one trusted it at 15K. Everyone wanted it at 60K. Fear keeps you out. FOMO pulls you in. Discipline is what keeps you profitable. This is my strategy, but it's not financial advice. Alright, the question I get daily. What are you doing right now? First, not financial advice. Second, if it were, you should still think for yourself. Here's my framework for 2026. 1. Dollar cost averaging. I don't try to catch bottoms. Nobody does consistently. Not traders, not funds, not your favorite influencer. Instead, I spread entries over time. Price dips, buy a bit. Price dips more, buy a bit more. Price pumps, pause, breathe. Don't chase. It removes ego from the equation. Because the market punishes ego with surgical precision. 2. Discipline beats brilliance. You don't need to be a genius to win in crypto. You need to not sabotage yourself. The biggest enemy of your portfolio isn't volatility, it's impulsive decision-making. The market doesn't care about your feelings. It responds to supply, demand, and liquidity. 3. Stop checking charts every 2 minutes. Yes, I'm talking to you. Let's be honest, you open the chart, close it, reopen it 90 seconds later like the price might have texted you an apology. Checking constantly doesn't improve outcomes, it amplifies anxiety. Watching the 1-minute chart is like staring at the microwave countdown. Time doesn't move faster, you just suffer more. Zoom out. The 4-year chart tells the story. The 1-minute chart tells a horror movie. The moonshot scenario. What if 72K breaks? Now let's flip the script. Bitcoin breaks $72,000 with conviction. This isn't just a number, it's a trigger. Here's what happens next. Short liquidations cascade. Traders betting against Bitcoin get liquidated. Forced buying pushes the price higher. Algorithms flip bullish. Trading bots detect breakout momentum and pile in. Media narrative shifts overnight. From crypto crash fears to Bitcoin resurgence shocks markets. Global FOMO ignites. Search trends spike. New exchange signups surge. Your cousin who called it a scam asks how to buy. This is how cycles accelerate. The road to $100,000 doesn't start with euphoria. It starts with disbelief, then skepticism, then sudden panic buying. And by the time the crowd is convinced, the price is already far higher. If you remember nothing else, remember this. 1. ETF accumulation. Are institutional flows continuing to absorb supply? If yes, the supply squeeze tightens. 2. The 65K 72K range. This is the battlefield. Break up, momentum, breakdown, volatility, not necessarily doom. 3. Retail sentiment. Extreme fear has historically preceded major rallies. When everyone is scared, opportunity often hides in plain sight. Now I want to hear from you. What is your BTC price target for the end of 2026? Comment the exact number below. I'll heart the most interesting prediction. Not the highest, not the lowest, the smartest. And remember, the market doesn't reward speed. It rewards conviction. It doesn't punish mistakes. It charges tuition. Stay calm, stay sharp. And for the love of Satoshi, don't let fear sell your future.